Hey, thanks for joining us. We are going to be talking about the infinite banking concept and real estate investing. Stick with us. Let's dive in. First thing I want to talk about is this quote I once heard, and it has always stuck with me because I think it's so true in life. And we're here, you're listening, you're learning because something in you says it's time for a change. Even if it's not all bad going on right now, you're thinking, I can improve something. I can do it a little bit different and get a little bit better. Or you're in a certain position where you're like, I've had enough of what I'm currently doing. It's time for a real change. And so I love this quote by John Maxwell. He says, people change in 4 different seasons. He says, when they hurt enough that they have to, or when they see enough that they're inspired to, or when they learn enough that they want to, or when they receive enough that they're able to. So anyway, I just wanted to jump out with that. And I thought it's so true. Like, are we hurting enough that we have to change, or we've seen enough we're inspired to change? Or have we learned enough that we want to change now? Or we've received enough that we're able to change? So what's your story? All right, I think there's this need for generational thinking that we've lost along the way. We don't think about it like we used to, like generations ago, how important generational thinking was. I also think there's a need for life insurance and estate planning that a lot of people are losing along the way. We think it's a boring topic. We don't want to look into it. We think it's too complicated. But there's a real need for it out there. We don't look into it enough. There's a need for income protection. We insure virtually everything else in our lives. We insure our cars, our toys, our houses, even our pets. But we don't insure ourselves. We are the machine that's generating income for us and our livelihood. So why don't we insure ourselves in a manner of protecting ourselves if we get hurt or injured and are unable to work, unable to produce an income? But we also have a need for the banking function, controlling the banking function in our life. That's what we're going to talk about in this program. How do we control the banking function in our life? My name is Jason K. Powers. I'm with 1024 Wealth. I teach people how to change the way they think about their money, and it's going to change their life. So that's what we're going to do. We're going to change the way we think about our money today. All right, what's every real estate investor want to achieve? Steady cash flow, of course, reliable income streams. We want access to capital for deals along the way. We want quick and easy access for that matter. Protection against market volatility. We get into real estate because we want to get out of the markets maybe, or get away from the markets, or have a second vehicle that's working for us, that's safer perhaps. And of course, generational wealth, the ability to build and transfer wealth to loved ones over time. I want to talk about a couple human behaviors. The first one is what we call the arrival syndrome. Now, Nelson Nash talks about that in his book, Becoming Your Own Banker. It basically is summed up as, we already know all there is to know. You say, oh, I've heard about this. I already know everything. Oh, I've heard about that thing. I already know all about it. Or have you? Have you heard how it's presented? Have you heard these things from its source? Have you heard this variant or that variant, and how is it impacting you? So it's just the idea of this, a lot of us have this, well, I already know all there is to know, so I don't want to learn. And Nelson Nash says it great. He says, when this arrival syndrome infects us, we stop growing, we stop learning, we rot. We turn off or tune out the ability to receive inspiration because we already know all there is to know. Okay? So I encourage you just to be open-minded today and listen, and maybe we'll teach you something you didn't know before. All right, we are constantly giving away control of our money. We finance everything, especially in this American culture. We finance everything we do in life: cars, colleges, credit cards. We finance our trips, we finance homes, we finance everything. Even your real estate investing, you're financing it for the most part, most of you. We also are putting our money into vehicles that we actually have no control over. So by financing things we don't have control over, really the bank does. And then putting our money into qualified, tax-deferred qualified accounts and so forth, or the stock market, those are vehicles we don't actually have control over. So we're constantly giving away control throughout our life. We really have to think differently about it if we're going to change our position. We don't have a money problem. We have a thinking problem. And I love how Albert Einstein says we can't solve problems by using the same kind of thinking we used when we created them. Okay, the next human behavior I want to talk about is Parkinson's law. It's got 3 parts to it. First part is work expands to meet the time envelope allowed. Let's talk about that for a second. Let's use a contractor fixing 2 bathrooms, 1 bathroom in each duplex. You've got a duplex, 2 units. You've got to remodel the bathroom in each unit. And so this contractor goes into the first one, he gets it done in 2 weeks, full remodel, and he's done. And you say, great, let's move on to the next one. You know what he's just capable of, doing it in 2 weeks. But you kind of let it slip. Hey, we don't actually need it done for a month, but you're thinking in your head, I know he'll do it in 2 weeks anyway, because he can. Well, how much time do you think he's going to take? If you gave him a month, well, he's going to take a month to do it, right? Or if you have kids, and your kids have projects in school, you were a kid once, you were in school once, how did it go for you? That project, they gave you a month to do it. How long did it take to do it? You could have got it done in a week or 2 weeks, right? Work expands to meet the time envelope allowed. The second part of this is a luxury once enjoyed becomes a necessity. I think a simplest explanation of this is things like air conditioning. If you got AC in a car for the first time and you knew what it was like without, you're probably not going to go back to a vehicle without AC again, or a home without air conditioning, for that matter. There's lots of things. Remote start on your car, lots of little simple things. A luxury, once enjoyed, becomes a necessity. The third part of this is expenses rise to equal income. As your income rises, we have a propensity to then raise our expenses. We have a propensity to then start saying, okay, well, now we can do this, now we can spend money on that, etc. Before we get that much further ahead, really. So the idea behind these 3 is this is something that we really have to overcome daily. This is something that we have to get control of, because if we're constantly living this out, we will never get ahead in our life. Okay, so it's time to think differently about our money. Let me give you an example of numbers. We're going to think differently about our money. If I ask you, hey, if you have $30,000, which method will make you more money? You want to loan it out at 6% amortized for 5 years? Or do you want to put it in a CD at 4% for 5 years? Which one makes more money? Well, at a glance, you go, well, duh, 6% is more than 4. That's an easy answer. But if you do the math, you will find that the 4% CD over 5 years will outpace your 6% amortized loan over 5 years. Well, why is that? It's because of this thing called uninterrupted compounding. In a CD, that 4% gain is going back inside the pile each year. You're reinvesting it of sorts, and it's growing on the new total, 4%. So it's compounding. The other one is 6% amortized. So you're paying 6% on a lesser amount every year. So we can't always just look at what's the interest rate. That's not always the question. Sometimes it's how is it growing? Or the other side, what is it costing us? How is the math being done? So I want you to think differently about money. But what if you have a vehicle that effectively do both? You could have a vehicle that you can be loaning it out, making money on it, and then it would be growing inside of this vehicle at the same time. I'm going to show you that today. It's time to think differently about our money. Right? Traditional thinking assumes we must rely on banks and debt, and we give up control. And we focus only on the products. What's the rate of return? What's the product? What am I getting my money back on? But we need to regain control by focusing on the process of how money flows through our life. Okay, where do we put our money? Well, obvious place is banks. We put our money in banks. What are banks doing with their money? Has anybody ever asked that? There's this thing called fractional reserve banking. The fractional reserve banking system, if you've never heard of it, basically says, that's a rule the Fed has that says, hey, banks have to keep X amount on reserve. And we, the general public, we go, oh, great, X amount on reserve, that's good. They'll have to have 10% on reserve, 12% on reserve, whatever it is. And so just a little history, pre-1992, the rule was 12%. They had to have 12% on reserve. And then in 92, up until 2020, it was 10%. And then when COVID was in full force, the Fed actually reduced that 10% reserve requirement down to 0 for banks. And as of 2025, they have yet to raise it. So what does that mean? So again, general public, we go, oh, well, cool, they have to keep 10% on reserve. I'm going to use the 10% example. They have to keep 10% on reserve. But we don't ever ask what's happening with the other 90%. What does that mean? Well, let me show you. Fractional reserve banking means, let's say you have $3,000, $1,000 a piece over 3 people. Well, they're going to take their money and they're going to go deposit it into the bank. Well, the bank then has to keep 10% on reserve. Right now it's 0 again, but let's talk about 10%. So they need to keep 10%. That's $300. And they're going to loan out $2,700 of it to other people. Let's say they loan it to 3 more people. Those 3 people, they take their money, they put it into the banking system, $900 a piece. That's $2,700. That banking system got. They keep 10% on reserve, and then they loan out the rest. So now $2,430 just got loaned out to 3 more people. Well, they go and put it back in the banking system. You see where we're going? And that money gets deposited. That bank then keeps 10%, loans out the rest. So just 3 times over. $8,260 got deposited, but there's only $813 sitting in the bank. Does that sound like a problem? It's going to be a problem when everybody wants their money back. Everybody going to want their money back. We're going to have a real issue because the money's not really there. Well, we say, well, what if the banks run out of money? There's this wonderful scene in the movie Mary Poppins, if you've never seen it, that illustrates that, where they talk about if everybody wants their money back, this kid, he says, the bank's trying to keep my money, and there's a panic. And everybody starts trying to withdraw their money. And you know what the banks are doing? They're locking their doors. Locking the doors, trying to reserve, save the money. Well, you've been around probably for bank runs. You've heard of bank runs. That's when there's a panic of sorts, and everybody goes to the banks and they want their money. Well, the bank doesn't actually have it. It's not really there. You see, not only just that it's not physically sitting there, the dollars aren't there because 90% of it's loaned out. Now up to 100% can be loaned out. Depends on the bank. You say, it's okay, my money's insured, FDIC, right? So here's some recent numbers that show the FDIC insurance fund. They have $9.5 trillion in insured deposits. There's $121 billion in the fund. That means there's $9.4 trillion uninsured. That's a big number. It's a huge number. Okay? So, a rule was made during the Obama administration that said it's okay, they can borrow from the U.S. Treasury if they're short. Well, the Treasury, where do they get their money? From the Federal Reserve. Where does the Federal Reserve get their money? Well, they print it. Okay? There's a game out there that you're very familiar with where when we run out of money, what do we do with it? This game, says, hey, if you're out of money, use slips of paper and start writing the amounts on it. Get some new money. And that's basically what we do. That can be a problem. Where else do we put our money? Investments, qualified retirement accounts, and so forth. Let's talk about tax-deferred qualified accounts for a second. What do they do? What do tax-deferred qualified plans do? Well, real simple. They defer the tax. They postpone the tax calculation. Okay? They defer the tax, and they even postpone the tax calculation, which many of us don't think that far. We say, okay, great, it's tax deferred, awesome. But we're also deferring the tax calculation of that money. We have no idea what that tax calculation is going to be down the road. Well, in real life, if you had $10,000 you needed to borrow from somebody, you would ask a couple of questions, okay? If you had $10,000 you needed to borrow, you'd say, well, how much interest do I have to pay? And when do I have to pay it back? If they said, well, we don't actually need the money right now, so we're not sure how much we need to charge, but there will come a time when we need the money and we'll know how much we need to charge at that time. And we'll let you know. And that's how much you'll pay us. Would you cash that check? No way. If they're like, hey, we don't know right now, but there'll come a time when we will know and then we'll let you know what it is. Would you cash that check? I should hope not. Okay, and that's what we're doing, this tax-deferred, tax-post calculation of our money every single day. And I haven't even talked about market risk. All right, another human behavior, Willie Sutton's Law. He was a bank robber. He got caught a bunch. And a reporter once asked him, why do you continue to rob banks? And he had a very simple answer. He said, well, that's where they keep the money. So Willie Sutton's law, the rule is, hey, wherever wealth is accumulated, someone will try to steal it. And that's the idea. Who's the biggest thief in the world? Who's the biggest thief in our country that tries to take our money all the time? Think about it. It's time to think differently about our money. Enter the infinite banking concept. Okay? The infinite banking concept, originally coined by R. Nelson Nash, who wrote the book Becoming Your Own Banker. Everyone should be reading that book. It's a short book, less than 100 pages long. You can get it on their website, infinitebanking.org. You can get it on 1024wealth.com. You can get it on Amazon even. So pick it up and read it. This is the foundation of everything we do when it comes to infinite banking. Infinite banking concept is a process. It is not a product. Right? It is a process, not a product. It is about controlling the banking function in our life. Where can we put our money? Where can we warehouse our wealth that has guarantees, that has safety, where we can access our money along the way? Okay? Now, the vehicle through which we show people how to do this is properly structured, dividend-paying whole life insurance from a mutual insurance carrier. Now, why do I get wordy about it? I get wordy about it because it's not just, hey, go get life insurance. Hey, just go get whole life insurance. Any kind will do. It's not like that. It's not even, hey, go get life insurance. I say properly structured because I'm not saying go get life insurance in a traditional fashion. We're saying it needs to be properly structured for the purpose of cash value access and growth throughout your life. That's its purpose for this vehicle. There are certain financial, we'll call them gurus out there in the public eye who rail against whole life, but the way they describe it is classic structured whole life. We are restructuring this into a particular way that maximizes your cash value growth. So properly structured whole life insurance that's dividend paying. So I say whole life insurance. You've heard of term insurance, you've heard of index universal life, variable universal life, whole life, permanent insurance. We're talking about whole life insurance, okay, in this conversation. Dividend paying from a mutual carrier is because there are two types of insurance companies. There are stock-owned companies and there are mutual carriers. Stock-owned companies, its interests are for the its interests are for the stockholders. Dividend paying mutual insurance carriers, as a policyholder, you're one of the owners of the company, thus entitled to the profits which come in the form of dividends. So we say dividend paying from a mutual carrier. All right, let's define the terms a little bit more. Types of life insurance, I'm just going to talk about two. The main one we are all familiar with is term insurance. We pay a premium, we get a death benefit. The other kind is classic whole life or permanent insurance. We pay a premium, we get a death benefit, but we build up some what's called cash value along the way. Now, what many people surprisingly don't know is that cash value you can actually borrow against. Borrow against that from your policy and use it however you want. Okay? So classic whole life insurance is more of a when insurance. It's designed to last for your whole life as long as you're paying premiums. Term insurance is if insurance, really. You're paying a premium, it's a lot cheaper, and it's for a term. It's for a time, 10 year, 15, 20, 30, whatever you get. Okay, whole life is designed, the price is averaged out for your whole life. So that's why we perceive it as a little bit more expensive. They're taking an average cost of this insurance for your entire rest of your life. Okay, we're going to take this classic whole life structure and we're going to restructure it. And you see it at the bottom here. And we're going to restructure, and we're introducing what's called paid up additions. Okay? So now we have two parts of our premium. At the top, classic whole life, we just have an all base premium, it's called. So I'm going to use an example of $10,000 in premium. The bottom, we're going to break that premium up into two parts, your base premium still and paid up additions or PUAs. So maybe we take that same 10,000 and we put 7,000 of it towards PUAs and 3,000 towards base. The ratio between the two can vary, and that depends on what you're trying to accomplish with your policy, which we will work with you on. But you're basically buying death benefit at a different rate with each pile, and in lieu of, you get more access to cash value along the way and more cash value growth. Okay, it's a very simplistic explanation of it, but just so you understand what's behind it. Now that cash value you can then borrow against and use it outside to make you money or save you money. That cash value is going to grow throughout your entire life for various reasons, which we'll get to. So the process really that puts us in control by utilizing this in simplistic terms, and we're going to drill down, is you save, you're putting money into your banking system. That's the save portion. You're funding your policy. You're going to borrow against that policy and invest it into, in this case, real estate investing. You're going to use it to make you money or save you money. Now, you are your own lender. You are your own banker. And you wouldn't borrow money from someone else and never pay them back, so pay yourself back. That's the replenish part. Have a plan to pay yourself back over time, somehow, some way, just like you would any other lender, and then rinse and repeat. And this cycle goes on and on and on throughout your entire life. Okay. Now the benefits. Let me talk about the benefits for a few minutes. We talk about privatized family banking. That's what I'm calling this infinite banking concept. The implementation of it is very much privatized family banking. I believe the single greatest benefit in this is the fact that your cash value will grow uninterrupted throughout your entire life, even when you're borrowing against it. Let me say that again. Your cash value will grow uninterrupted throughout your entire life, even when you're using it elsewhere. So if I'm using it elsewhere, if I borrowed against my policy, it's growing inside the policy as if the money never left. There's simply not another vehicle out there like that. There's a guaranteed growth component to it. There's guarantees. Okay? Income tax-free growth, which we're going to get to. Safe from investment bust. This is not an investment product. There's no market correlation, so it doesn't matter what the outside markets are doing. Unstructured loans, when you borrow against your policy, you get to dictate how and when you're going to pay it back. You decide. The carrier does not tell you. Loans are not tied to your credit. You, me, the insurance carrier know about it, and that's it. You can use it now throughout your life to make you money, save you money, and use it even to supplement or be your retirement later. Furthermore, at an income tax-free basis, potentially. Plus, it's life insurance. You have a generational wealth transfer component to it. Okay, so there are three kinds of people. We want to help you become a wealth creator. But usually there's the debtor. That's the average person. Let's take a car, for example. We want to finance a car. We're going to buy a car. We're going to go into debt. And we're going to pay it off over time and go back to zero. And then the time comes for another car. We're going to finance another car. We pay it off over time, go back to zero. And we do this throughout our life. So we're constantly resetting at zero. The saver does the opposite. The saver says, I don't want to go into debt over this. I'm going to save up until I have enough. And then they're going to save. And they save up, and then they go buy the car. And then they go back to zero. And they start accumulating again, save up for the next car. Buy it, go back to zero, so on and so forth. We want to teach you how to be a wealth creator, where you can create this financial velocity that can literally last for generations.